When thinking about our trading procedure and how we were going to implement it into our strategy, there were six key items we looked at. So first, we looked at our long and short positions. So thinking about our long and short positions, we thought it'd be best to be about 85 to 90% long and 10 to 15% short. Thinking about the nature of small cap stocks, I mean, you got to be a little more risk tolerant. You're investing for the future, looking for significant growth potential. So it didn't really make sense to short these stocks, and it made more sense, throw some money into length and hope that these stocks take off and we select the right stocks to, really provide that future upside. So secondly, we looked at our maximum cash holding value. So we wanted this to be a small amount. We decided on 2%. You know, again, thinking about small cap stocks, riskier stocks, you're investing for the future. You hold money in cash, yeah, you might clip a small expected return, but if we really want that significant upside, we do not want to hold a lot of cash. So thirdly, we wanted to look at PE ratios. And not only do we want to look at PE ratios, but we wanted to look at low PE ratios. So when a company has a low PE ratio, it signifies that the company is undervalued. And this is not a perfect science. It doesn't mean that all the time, but if we can find companies with low PE ratios that we really think are gonna, you know, blow up in the future and have really been on the right track, in the short term, medium term, long term, we think these would be good investments for our fund. Fourth, we look at maturity. And maturity is kind of twofold and it goes along with our fifth point of diversification. But maturity, we want to look at both the maturity of the individual stocks and the maturity of the industry. So when you think about the maturity life cycle, you know, you have your stocks and industries that are less mature, and then you have your stocks and industries that have gone longer through and they're more mature. So, weaving this in with diversification, we want to diversify and invest, a certain amount of funds in both stocks and industries that are more mature, and we know we're going to have a smaller expected return because there's less volatility there, but we know we'll still get something. And we also want to invest in firms and stocks lower in the maturity cycle where, there might be more downside, but there's also the higher risk for upside if these stocks do take off and we do select appropriately. So again, with small cap firms, we're, investing for growth, we're investing for the future. So it's really important that we take some risk when selecting stocks for that we want to implement into our strategy. And lastly, we want to look at the MOM, which is the momentum return metric. So really what this is doing is it's looking at a measure of your asset class's past returns and seeing how that's performed over, short term, medium term, long term, etc. And stocks with higher MOMs really signify higher future growth opportunities. So if we can find, the perfect stocks or the perfect examples of a high MOM, a low PE ratio, you know, lower to mid of the maturity life cycle, we really think by investing and putting some length into these firms, there will be some significant future upside for our portfolio. These are really the six metrics that we wanted to bring into our strategy, and Mathan will talk about it a little bit more later when he goes on to provide examples of what we both did invest in and did not invest in.